Hi Fools, I'm David Williamson and welcome to Market Checkup, the Motley Fool's healthcare-focused investing show. We're going to go over who's winning and losing in today's market. Now, biotech is bouncing back today in general, but we have three stocks soaring higher on specific news that makes them today's winners. Up first is Puma Biotechnology. It's up 15% after the European Patent Office has ruled in its favor. Now, this over-the-pond matter involved Boehringer Ingelheim challenging the validity of its drug patent for an irreversible EGFR inhibitor for cancer patients with a specific T790M mutation. Now, this patent is extremely important as Puma has only one drug, PB272, which it acquired from Pfizer in 2011. This drug is in 9 different trials in combination with other drugs and by itself in both breast and lung cancer. Most are mid-stage, which means we should be getting hopefully a lot of this data in the near-term future. So this stock is definitely one to watch. Now, Cytokinetics is our big winner today. It's up 30% thanks to some tremendous fourth quarter results. It announced $24 million in revenue, which may not seem like a lot, but it is an 11x improvement over where it was last year. And my favorite part is its earnings per share of 21 cents versus a Wall Street estimate of an 8-cent loss. So swung from a decent loss to a really nice gain for Cytokinetics. This beat was powered by collaboration revenue. Cytokinetics has a couple of notable partners. The biggest is Amgen. Cytokinetics is currently working on 3 drugs. The most hyped is the one that's in collaboration with Amgen. It's in heart failure. I do agree with fellow fool Sean Williams, who wrote about this stock today. He said it's probably better to wait and get more data before investing. I think that's absolutely right, given this heart failure drug's mixed mid-stage results that resulted in actually a 38% plunge in a single day in early September last year. We should see results from a different Cytokinetics drug in the coming months as well, so stay tuned for that. Our third winner today is actually not a biotech. It is a healthcare IT company, and it's Athena Health. Shares are up 25% on fourth quarter results. Revenue grew substantially to $171 million, which slightly beat Wall Street estimates. But the real news was on the bottom line, where the company humiliated those same estimates, earning a whopping 57 cents per share versus a consensus 44 cents, thanks to largely a tax benefit, but some surprising margin expansion as well. The healthcare IT company showed good growth by increasing the size of its network of doctors by 28% and bookings by 30% for 2013. Now, this is Athena's third earnings pop in a row, and the stock has now doubled over the last 12 months. This stock isn't just relying on the health reform tailwind, which it certainly does have at its back, but it is smoothly executing its growth plan as well. It's a popular stock here around the Fool, and it should be one investors are watching closely. So let's move on to today's winner or today's loser. Unfortunately, the other side of the coin. And it's really one big insurance titan, Cigna. Now, earnings has been tough sledding for a lot of the managed care stocks, but none worse than the bloodbath seen today at Cigna. Shares of the $21 billion company are down a startling 10%. The fourth quarter is not where anyone wanted to see, and guidance was a big problem as well. Revenue was actually okay. It did beat expectations. The real problem was on the bottom line. Earnings fell. Net income was down $45 million to $361 million. And even after backing out one-time items, earnings per share was still at $1.39, which was 10 cents light of the street's estimate. And it's even worse compared to last year, where Cigna earned $1.57 per share. Now, it also indicated that 2014 would be a challenge throughout the year, and first quarter earnings in 2014 will probably decline as well, which has really caused a bit of a stampede out the door. Now, shifting gears to how Cigna is impacted by the Affordable Care Act, this is what a lot of investors are curious. How is health reform impacting these companies' businesses over the last quarter? Where is it going to go in the future? Cigna did say its Affordable Care Act customers, as of the beginning of 2014, have skewed older, but it only has 20,000 members from the insurance exchanges, and it doesn't expect to make any money off those exchanges this year. Aetna, by comparison, which has been a pretty vocal critic of Obamacare, has 200,000 members, so that's a whole magnitude bigger. It also expects to lose money on the proposition this year, which is largely why it's been a critic. Aetna has seen the demographics skew older, and it is even mused about withdrawing from the exchanges. It's concerned partially about the backlash that'll happen if it has to increase rates if its risk pool doesn't improve from where it currently is. That's not to say it's all bad news for Affordable Care Act insurers. The happiest of the bunch is WellPoint, which purposely set out to have a large exchange footprint. It is roughly 400,000 applicants from the Affordable Care Act exchanges, and it does expect to make money this year. So, don't think the Affordable Care Act is, don't think of it in generalities. It's a very company-specific implementation. So you need to see how they're competing, how many exchanges they're competing in, where their plans are really competitive in price, if they're trying to compete more at the platinum level or the bronze level. So you really have to dig in there, and you can't paint the insurance industry with one broad brush. But the one part where a broad brush may be appropriate is with Medicare Advantage. Now, this is an important program to the big insurers, and for Cigna, unfortunately, costs in Medicare Advantage is what really stung this quarter. The program has generally been a big win for insurers, but concerns over increasing costs and reimbursement cuts are looming. The date to circle for that is February 21st. That's when the new Medicare Advantage reimbursement rates will be released. Concern over these rates being cut is significant, potentially in the 6% range, and that's ramped up over the past few weeks. This is what's really been weighing on investors and, by consequence, driving the short-term underperformance of insurance stocks. If rate cuts are only in the 3% range, I would expect a nice little pop, but cautious investing to all when it comes to thinking maybe you can get in there and figure out what the government's going to do. But this is really, it's a very important driver in the short term, and it's something investors need to be cautious about before they jump in with both their feet. Thanks for watching Market Checkup. Stay tuned to Fool.com for all your healthcare news, and Fool on.